Okay, hello everybody, and welcome back to another Pepperstone Day Trading Strategies Learn It Live here on YouTube. I hope everyone's having a great week. It's been an amazing week of volatility, and obviously, I'm joined by Tyrone and Abela. Tyrone, how have you been going? How's the week going? I mean, it's incredibly volatile, isn't it? But it's also exciting for FX traders because we've had some great moves over the last couple of weeks.
Yeah, we certainly have. Welcome, everyone. Yeah, we've seen some really good moves on a few of the majors. I know we covered a lot of them on the weekly videos last week, but yeah, they've certainly played out. And I think, realistically, you should have been able to take advantage of, you guys are intermediate traders, this intermediate webinar. So I reckon you guys probably got a piece of these. So yeah, certainly let us know in the comments if you've been trading some of those really good breakouts, especially the US dollar yen. Yeah, certainly let us know. We'd be interested to see how you're going with that.
Yeah, so the US dollar yen certainly been a popular one. Ty, let's just ask the community straight away. What have you been trading recently? We'd love to get some interaction here tonight with some pairs that people have been trading. What's your interest at the moment? Is it gold? Is it odd yen? Is it US dollar yen? One of the yen pairs in general, they've been very hot. Of course, today we'll be talking about a whole bunch of things. We're going to be talking about managing risk during volatility. Of course, we have a lot of volatility right now. Key time frames that we've got on the radar when it comes to volatility, when we want to be nimble, when we want to be fast and quick in markets. And then, of course, we'll be looking at charting and technical analysis and a live Q&A along or as we go. So if you have questions, please feel free to ask them in the community. We'll answer it as we go. And we've also got some helpful staff members out there as well that'll be following along. So Ty, just before we get started, as always, remember, we do have a risk disclaimer. So I'll just quickly play that, pay some attention to it, and we'll be back in just a few seconds. All right. Thank you very much. So let's get started. Let's see what everybody's been taking a look at here. Paul says he's been taking a JPY 6 basket with no New Zealand. So basically a little bit of all of the yens together and grabbing them. And look, that's not a bad idea. I mean, basket trading is something that you can do, but you obviously got to risk or set your risk around that. I'm sure you do there. Paul, absolutely. So which trading pairs are best to start with? Well, I think, Ty, in points of volatility, we really want to stay with majors. Now, we always have this slide up all the time. We talk about yen pairs. We talk about US dollar denominated. A lot of people don't understand, why do we use the US dollar so much? Because it's the major. It also is quite stable in comparison to everything else that can be moving around it. And we need to also remember that in the world, most transactions are actually done in US dollars, aren't they? A huge percentage are done in US dollars, like
That's
80% or something.
100%. And look, not 100%, but yeah, you're right. The thing you've got to really be mindful of in volatile markets is that you're already trading in a risky market. So you don't need to be adding to your risk by going too exotic on some of those pairs that you can barely pronounce, right? Because volatility tends to widen spreads, as you know. That happen in some of these very exotic pairs, but when you stick to the majors and some of the key indices and some of the key commodities, you're going to see very good trading environments that aren't actually gapping on you and really causing you too much grief, even though you're getting the good volatility to allow you to get in and out of trades.
So, Ty, I want to talk about a few. We're obviously doing an intermediate session today, and I want to talk about volatility and how we really risk around that. So, someone mentioned baskets before, and I think that's a really interesting concept. But another thing that you want to be doing is you want to be thinking, okay, which one is relatively stronger than the others? So, when we think of the idea of basketing a currency, what you're really doing is you're trying to figure out which one is stronger versus the other one. So, let's have a look at some yen pairs in recent weeks. You've got here the pound very strong versus the yen. The yen obviously weak up until this point over here. You'll notice this huge strength that's come through it. If we go and look at the odd, even stronger. Look at that vertical movement. So what tends to happen is when you have a strong currency, let's say the odd, against comparatively strong against other currencies as well, such as the US dollar, when you see a breakout of something like a major, e.g. the US dollar yen, you might want to go and think, okay, well, how can I potentially place a better trade than this? So let's have a look at the US dollar yen trade and actually break it down just quickly. So here it is. There's the exceptional movement. And this was coming off an incredible base. Now, plenty of people at Pepperstone have been talking about this one. I'm sure most of you are aware by now. that this yen trade was going through. And when it breached, there were a few things that happened into this breach that I think we need to pay attention to. And let's just go through some of the things that you generally want to see with price action. The first thing that happened is we saw a series of higher lows. That is, each time it sold off, the market comparatively was making a series of higher lows. We also saw an increased amount of volume recently coming through this pair up until the breakout. So there was an increased amount of volume showing us that there was a lot of transactions going on in that particular time frame. Now, if we break this out to a weekly as well, this is what we call an amazing chance for participation. And when this broke here of the middle of March, the 7th of March, what actually occurred was we breached past an incredible area of resistance. And we can move then to the next level, which is something around that 118. And of course, where it's getting to right now, which is up near that 120 level. Why can we do that? Because think about the price action so far. We remember price action is really a story. And when we're reading the charts, we're looking for a story. Here we have rejection candles. We have more rejection candles. We have a buying candle, and then we have one that closes above all of those points. When this occurs, we enter what we call participation phase. And I want to go into this idea of the Dow theory and this idea of Wyckoff's theory, if you've never used those today, and just break down this concept of when we enter or exit an area of consolidation, if we can see on a higher time frame, such as a weekly, another point of resistance or another point of far away, we tend to enter what we call participation phase, or basically the rally where everyone gets in. Some people call it markup. So this is an incredibly important thing to recognize in markets, isn't it, Ty? And whether you're using a volume profile to find it, which you can do, and I'll insert a volume profile now while we talk about it. Ty, how important does this type of stuff become?
Oh, very, very important. When you understand what the idea is to actually anticipate the move, and your warning signs are all there. Like we're getting a series of higher highs and higher lows even on a weekly, right? So we are building up to a break, no question about that. As you can see, as that point was being approached, is that around that 114, 115 area, the volume was already increasing. So we kind of already knew. But, you know, for us as traders, we were looking at that 20 moving average. It touched a 20 moving average, and it was having another big assault at that level at around that 115.50. So even though, it hadn't actually broken it at that point, you knew that it was actually building up towards it. And then when you got that closed candle, that's when the participation phase kicks in. Once that happens, the rest of it's pretty much going to take care of itself, really. And it played out very, very nicely, I must say. It got to the initial target of around that high 119 to low 120 very, very quickly.
Yeah. And you can kind of see it here. I mean, obviously, with volume profile, you'd also want to put in ranges, but you can tell on the charts what's happened. It's been sitting for a very, very long time. It's then held a series of higher lows for a very long time on the weekly. This is not always going to come around for a trader, for an investor or a trader or whatever you're doing in the markets. But when you recognize effectively a breach of a zone like this, it becomes incredibly significant. And we can tell that it's significant because, of course, we're in uncertain times. But this is what's been happening a lot in the FX market. We've been breaking past key points of support and resistance, and we're in a trending market. A lot of people don't know, Ty, that markets don't trend that much during the year. In fact, I would say about 5 months of the year we're trending, and the rest of the time we're actually usually trading in ranges and pairs.
Yeah.
And it's your job as a FX trader or gold trader or anything to recognize the times when a market is range bound and the times when a market is moving through. And one of the best ways you can do it is adding things like volume profile into your strategy. And really, it's just really about supply demand, understanding the next point of resistance and the next point of resistance. If this level breaks, this becomes more likely to occur. And that tends to be very free flowing, which helps you as a day trader, which helps you as a scalper. So, of course, the yen has been the story of the last couple of weeks, but there are some other ones. I had the pound US dollar up before, and I'd like to go back over to that just for a second here and have a look at the pound US dollar. So we'll get rid of the volume profile for a second here, and we'll just talk about the pound US dollar. So what has the pound US dollar done recently, Ty? It's breached below, and then it's gone lower, it's rallied through, and it broke past the daily 20 moving average here, and it's coming back down. Now, the reason why I find this significant is when we start breaching through or going through some of the different time frames. So let's use a multi-time frame technique. We go from the weekly, we go into a daily time frame here, we go into a 4-hour time frame here, and what you start to see is some interesting price action. Do you notice anything here straight away that catches your eye when you look at a chart like this?
Oh, no, most definitely. You've got a 20/50 moving average crossover for starters on a very no nonsense time frame like the 4-hour, and we're also obviously getting a series of higher highs and higher lows. But we have broken past that level that was previously a support level, and now we're above it. So not only is it broken that level, it's actually coming back down now and actually testing that level from above, which is giving us a mini roll reversal zone. Now that's going to coincide with the 20 moving average, of course, and you're going to get double protection from that point onward. So we like to look at that. Yeah, when we're looking at these sort of trades, we're definitely looking for double, triple, quadruple sometimes reasons for why a market might stop in a particular area. That gives us the opportunity to actually reload. And it also gives us the opportunity to, if you're already in it, basically mitigate your stop losses by potentially moving them up. Because I mean, if you're already in that trade, you could be moving your stop losses up at this point because you've got a lower high that you can actually, or it's a higher low, I should say, that you can actually move your, because you've already broken a pretty key zone.
Yeah, so I mean, we've also got, I think, here a bit of a pattern that's formed, and that pattern is potentially inverse head and shoulders, where you've got the head, the left shoulder, and the right shoulder, and we just have an amazing level of role reversal here, Ty. And how this is going into what I would call a box. So generally, when you're drawing support resistance, a beginner trader will say, I have to have a certain price. I remember that, Ty. I remember going back and we used to say, oh, we have to have this price and we have to get this right and all of those types of things. That's not something that you want to be doing. You want to basically be saying, okay, I want to recognize a range and draw in that range. Usually the best way to do ranges, by the way, just if you ever want to do it, is draw from the bodies to the wicks, something like that. So whether it goes to this wick or that, you're going to basically draw something around this kind of area here and say, all right, if it enters this zone, what I then do is I start to look for the turnaround story. And that's something that you really want to be looking at. So yeah, I think that the pound US dollar is an interesting trade pair right now, right in this area. Obviously, it's just an interesting technical. You need to think about it from your types of systems and things. But right now in a point of volatility, the great thing about volatility is it tends to give us a lot of movement. The bad thing about volatility is it moves quickly. So what time frame are we going to be better to be trading on? So we saw before the US dollar yen, we had that on a weekly closure. After that weekly closure occurs, we might have a plan to get it towards that next zone. But we want to, of course, be looking at it on a 5-minute, on a 1-hour chart, on a 15-minute chart, and looking for potential entry points. So just like on a chart like this, if you were interested in this, probably your positioning would be somewhere on something like a 15-minute or an hour, wouldn't it, Tyrone? And you'd be looking for turnaround stories in this area, just say, as an example, to be particularly looking for your systems in times of volatility.
Definitely. And this is why we actually draw a zone in the area rather than just a particular price. You don't want to be getting caught up on that one particular price. It's amazing. Look, Thomas and I do this all day, every day, and it's amazing how many people we talk to. Even clients sometimes actually say that they don't want to buy BHP until it's exactly $34. And the amount of times it'll get to $34.20 or 40 or 50, and then off it goes and completely puts on $8 or $9, it would amaze you. And it's no different in currency. If you get too focused on a particular price point, it's going to leave you a lot of the time and you're going to be disappointed. Whereas if you draw a zone like we've got here, what you're able to do is then pinpoint the change of trend in the smaller time frame. So as you can see, we've got this rectangle. That's not one price. That's actually a rectangle of a band of maybe 20 or 30 pips. And inside that, you're able to actually pinpoint a little bit of a change of trend on the smaller time frame. Now, it's not going to happen on the time frame you draw on the rectangle on, but it's certainly going to happen on the smaller ones. This is a 15-minute chart, so it's not a great example. But if we were looking at a big time frame and we had this particular setup, the minute we get a series of lower highs and lower lows, or higher lows, higher highs and higher lows, then we know that trend has changed inside that area of interest. And that's when we get in. We don't worry about it coming back to 131.99.4. We're going to take it as soon as it makes a new high.
Yeah, absolutely. That's exactly when we're going to look at those types of things. And I think if we recognize it as a key level, the key here is actually recognizing for that turnaround tide. The intermediate trader will wait for that last part of confirmation. During
Yep.
volatility, it's incredibly easy for us to say, all right, let's get in, let's get in, let's get in. The problem is, what are Warren Buffett's two rules? Is number one and number two. Rule number one, don't lose money. Of course, it's they're great work, Buffett. Thank you very much. Rule number two is don't forget rule number one. So Ty, it's mostly like Fight Club, as I like to think it here. Basically, don't talk about Fight Club, yeah. But in this case, the way that we're looking at the markets is we want to try to give ourselves the best probabilities of being successful. And one of the ways to combat volatility when the VIX is above 20, that is the fear index, the VIX, or many people call it the VIX, the fear index. When it's above there, we're going to want to get that extra confirmation, drawing boxes, creating a zone of interest, and then looking for the turnaround on the smaller time frames can help you to place better decisions. Now, I'm going to show someone a little bit different here. I want to show you a US 100 or Nasdaq US 500 that happened yesterday. And the reason that I want to show you this is because I think it's paramount to understanding how fast these markets are moving. And we'll use the US 100 here. We'll just type in the US 100 as a code and we'll bring it up. So here it is coming into a market open. Now we know that all these markets are incredibly volatile, but I want to show you a technique that I often use around session opens. And I think that it's again just a really helpful technique that can help people to make better informed decisions, and it's replicatable when you continue to see these. So what I like to do is I like to draw the top of the range for that market during the previous periods and the bottom of the range. And the reason why you want to be doing this is because you want to understand, okay, what's happened during the Asian session in the futures? What's happened during the London session in the futures? And then when you enter into, of course, the US Open, if it's near a point of the resistance or the session high or the support of the session lows, what we're doing then is we can say, okay, well, if it breaks out, we're looking for the trap. And this is a big, big move in terms of volatility. Volatility equals traps, Ty. That's what it equals. It always brings traps. And I mean, I can't think of any greater time than it is when we're going down the line of volatility to think, okay, yes, we're going to probably see a ton of traps that attack really the retail mindset. That is, it goes off in one direction, reverses one direction, and then reverses off, or it goes in one direction heavily, sells off, scares you, and then moves through. And anyone that's been trading any of the markets at the moment would know that there's plenty of traps, and you don't really want to be going against the trap if you can help it, do you, Ty?
No, that's right. Look, some people treat volatility as a reason to actually get a little bit sloppy because they think they have to rush their trades. Realistically, volatility means you need to be more careful. And yeah, it's a common mistake. Like we see it all the time. Where you got to think. I know we keep referring back to Warren Buffett, and that's all good. But really, when you look at any trader, whether it's a professional or whether it's actually someone of note, just think about it from the mindset. Do you think they are first in, or do you think that they're probably looking for the right setup and they're not going to be very trigger happy, I suppose, if you like? That's probably the word I'm looking for. You've got to think like that. Now, look, I know you guys are intermediate traders, right? So, we're not expecting there's too many novices in here that are just trigger happy on the button. But I think sometimes when volatility is very, very strong, you can fall into the trap of actually being, a little bit rushed. I think that's probably the word. You feel a little bit rushed to actually get in, but patience is still key, no matter how strong the volatility. If anything, it actually requires more patience. The volatility is going to give you the move that you need, regardless, right? So if anything, it means you can actually be a little bit more relaxed about your entry and wait for the confirmation, because you're still going to get a good move, because that's what the volatility is there for.
Yeah, so let's break it down now, talking about the session high. So the first thing that happens, you can all tell over here, the volume increases. What happens? The volume comes through. Obviously, the session starts. So the session starts and it ramps up. Then instantly, a few minutes later, remember, this is easy in hindsight. I understand that, but this is a replicatable thing that you would see happen all the time. It breaks through, and then all of a sudden, it comes straight back down that first couple of minutes. Remember, this is all happening in the heat of the moment when the session opens, whether it's the London session and you're trading the euro US dollar or the pound US dollar, or it's the Asian session and you're trading a yen pair, who knows? But when you tend to see this thing happen, this is a go-to very simple strategy or very simple concept. It breaches out, it reverses, and then what you see is effectively tweezering style bottoms. So you see a rejection wick followed by, in this case, what they call a pin bar or bullish hammer. Now, it happens so quickly that you'd almost be looking at it saying, well, wow, this is happening very quickly. But think about the psychology of this. It breaches out. It makes people think it's a false rally through. It reverses those very quickly, rallies, which is pretty much the point that you want to be getting into when it starts going back through. And then, of course, people will usually look to scale into their order, something that a lot of beginner traders don't do. But tweezer trading, in terms of looking for rejection wicks, is very, very strong when you get the follow through. So when you have some kind of movement through, especially during volatility, you then have a reversal and then wick purchasing. What is that telling us about the market? Every time we see these types of things occur like this, it's telling us that there are buyers and they are ready to come in at that level. They are committed to the trade, and then it starts to flow through. And when it's more about the two in front. Now, if you have these, e.g. over here even, if you have these types of tweezer setups, because there's two, and if there's three, even better. And if there's four, maybe get a little scared. No, but it gets better and better and better is the way I look at it. Because what it's telling you is it's always showing you a strong rejection off that level. And if it happens around opens, it's super, super powerful. It's super powerful, isn't it, Ty? So I wanted to ask anybody, has anyone been trading any of the indices with Pepperstone recently? Has anyone been trading the US 100, the S&P 500? Obviously, the markets have been exciting as well. This strategy, this concept, remember, can be applied to the euro US dollar, to the pound. I'm just saying it's here because I saw it yesterday and I thought, you know what, I've got to tell everybody about the idea of tweezers, because if you're not using tweezers and you don't recognize them in the markets, they tell you much more than you think. It's not just saying, oh, there's a pin bar or there's a hammer, is there, Ty? They're talking about real buying volume.
Yeah, you're getting more and more confirmation when you see them. They're very, very powerful. Probably underrated resource, really, when you actually see them, because it's very, very important price action.
Yeah, it's very important. And if you get it around an open, conversely to this, let's say at a breach through and you saw like a reversal followed by another reversal, man, that would be a very strong trade towards the short side as well. If it breached the session high and went reverse. And this is basically what you're doing, is you're being reactive to the market during volatility rather than trying to be predictive. Remember, the problem with many traders is that when you're looking at markets, you might say, okay, when I come in the morning, I'm going to go long. All right. And you're trying to predict where the market's going to go. Probably not going to work out for you. You might as well be coin flipping, because you're not exactly, I mean, maybe you might say, oh, I knew it. Did you really know it? Was it really replicatable? I always hear when someone says, oh, I should have done that. How many times have I said that, Ty, to you? Probably about 1,000. Yeah. Why didn't I do it? Not a week. But yeah, certainly something that I do. So,
everyone does it. Everyone does it. Of course I do.
Yeah.
But it's okay. And don't let that trick you into thinking that you've got to take every single trade that you see. Only take the quality. That's important as well. There are going to be times when you're like, oh, far out, I knew it. As I said, but don't revenge trade on that, right? That's not what we're talking about. Don't say, I knew I should have done it. Let's get in anyway. Goodness.
Yeah. No, exactly. So I'd like to answer some questions here that are coming through, Ty, but I'd also like to remind everybody, if you haven't already subscribed to the Pepperstone channel, please remember to do so. There's so much great content coming out right now. And also, if you could smash that like button, it would help us out as well. It's so make sure to do that if you enjoy it. Now, I'll answer these questions. What kind of news or facts impact on the Nasdaq 100? That's a loaded question. A lot of news and things impact on it. But as a trader, I think if you try to interpret the news, you're going to have a really hard time. The problem with news trading is that you've got to remember what else is in the market, regardless of whether it's the Nasdaq, whether it's the euro US dollar or the pound US dollar or anything. When news comes out, algorithms immediately start trading that news. Really, what you're doing by reading price action or using your indicators or using VWAP or using whatever else is you're interpreting the way the market interprets the news. And guess who's probably better? You trying to interpret the news, or me? Probably not. Or Tyrone? Very much, we're not going to be the smartest people in the room. We can't beat them. But the price action, the market will tell us the news. And when you have no bias, and this is something I want to say in volatility, Ty, we tend to draw in trading biases. So we have bias. Now, I know for a fact that whenever you go and you learn about diversification, you learn about these things, there's like more bias, different versions of it than I've ever heard in my life. There's like 15, 20 different types of bias opinions. Now, they are incredibly dangerous to the trader. And unfortunately, you have to be a bit like a robot. Every single good trader becomes a robot. You might have an opinion, but ultimately you'll let the price action come along with it. And if it agrees with your opinion, you might have a bit more confidence. That's very important, isn't it, Ty?
Yeah, definitely. Yeah, definitely. It's one of those things where people don't think they're letting their bias get involved, but I think you'd be surprised. You've really, it's okay to have, and it is okay to have a bias, but you take every move that you make. You've got to be able to spin on a dime. Remember, we always say it, and it's really, really true. What we have as an advantage as retail traders over the big instos is that we can be agile. Okay. And that agility means that we can switch from long to short with just a second's notice. That's where if you've got a bias, you won't be able to do that. You'll mentally not be able to handle that. And that's, it's a no-no because you're going to miss out on a lot of good opportunities and potentially enter bad one.
Exactly. So we have another great question here coming in from Joe, and it says, so when are these tweezers or these types of trades invalid? So when are they not going to work? Well, it's a great question. So let's look at some scenarios right now, and I'll just draw out some scenarios where these types of trades tend to be credibly valid. So if we have, let's say at this point here, a point of resistance, we end up creating a tweezer at this point, and we move through a double, very valid. Very, very valid. An absolutely amazing kind of price action. One of the better, ways of course, spotting it. And if you see it like that, fantastic. Another one is the scenario we just saw. We might have a session high, session low, a breach, a retest, which is very similar to what we were just talking about. Again, very, very valid. Another one is sometimes you might have just a trend following down. It comes back to a Fibonacci level like a 38.2, and you see it appear. It can be relatively valid. Now, is this as strong as the others? No, but it's still very valid. When it's not valid is it usually when it goes against the trend. So when it's breaching a breakout or it's coming on down in the direction of the trend, very valid. But if it's going against, so let's use a scenario like this. And then all of a sudden you see two up the top. Okay. That is going to be a fairly decent, probably potential scalp, potential trade. You might be looking for mean reversion. It will be slightly less accurate. You need to remember you're going against the overall prevailing trend. And depending on where you are also on the higher time frame, and this goes back to that yen trade before, when you see that huge move, probably a fairly dangerous type of trade. The key though with everything here, and I want to really point that out, is if you see these types of positions or any position, whether it's an engulf, whether it's something like these tweezers, whatever, if you've got like a little wick on it here, don't just buy it immediately. Allow the trade, allow the movement to go through and to create the new high. And what Tyrone and I teach in our course is that we breach it by percentage. So say this was, let's call it 20 pips. What we would do is we would allow maybe 2 pips of movement past the high before we got in, a percentage amount. Now, why do we do that? Because it's not always 1 pip, by the way. It's always going to be a percentage of the candle. We do it because we want to make sure the momentum is going in that direction. I think that's what I want to get at today. Volatility creates, Tyrone mentioned it before, itchy fingers. We like to get in. The problem is we get burnt by having itchy fingers. So we have to be more confident and more refined as a trader and investor than ever before. If we're not, we will get burnt a lot. One of the ways of doing that is when you see your signal, your system, maybe what you should be bringing in, and this would probably be the story of the day, allow the trade to go a little bit further in the direction. Now, you might give up 1 or 2 pips or 1 or 2 little points, but what you're doing is you're confirming that everything you thought about that market is correct.
Yep. And just to add to that too, it's a bit like, when you're looking for when are they valid, it's very similar to how we look at hammers, shooting stars, bullish engulfing candles, bearish engulfing candles, whatever candle. Where they are located is extraordinarily important to the chance of their success. If they're in the middle of nowhere, chances are it's going to be a nothing trade. If they are at that support or resistance or at a reversal zone, like Thomas said, it increases their chances of actually working out by an unbelievable amount. I can't even begin to tell you, I can't even quantify it, the change it makes. So if you see it in the middle of nowhere and it's clearly in the middle of nowhere, that's probably when you're just going to leave it alone. That's just price movement. But at those key support and resistance zones that we're talking about, or the pullback zones, they'll work their weight in gold. Absolutely.
And I just wanted to show it because I saw it yesterday and I was doing a stream on our channel at the time, Ty, and I just thought, you know what? Somebody pointed it out to me and I thought, you know what? Wow, that's you don't see it every day, but it's a replicatable pattern that comes across quite often. So it's a great question there, George. Does that help answer it? Just let us know if you're still there. Let us know what you think. Also, ask some other questions. This is an intermediate session. Obviously, volatility is something that we're all trading right now. We like boxing, which is something that we've discussed, waiting for trend change in the box. And then we also like, of course, looking for confirmation. And one of the reasons we brought that up was because if we have confirmation, that real nuance there is wait for that little bit of momentum. How many trades? I'll put my hand up again for this because I've done it plenty of times. It's why I've learned to do it this way. How many trades? It looks good. You get the entry signal. 2 seconds later, it's hit your stop loss and gone backwards on you. It never went forward even another pip. Not even a pip did it go forward. Woo! It's nasty out there, guys. It is nasty. So Andrew said, hey, fellas, can you go back over the pound US dollar chart? If price broke above your box, where would you set stop loss and target areas? Over what time period might you expect it to run? So it's a really great question. And obviously, we will answer as best we can here for obvious reasons. But look, the way that you think about and conceptualize how long you would think something is going to be running for or where you would think it goes to is pretty simple, really. What's happened recently? We had a support that has become a resistance. Now, if this particular trade was to be successful, big if, big was, then where would it potentially go to? That 134 would be a good next technical resistance, wouldn't it, Ty? Somewhere in between here and here would make some sense. Yep. And this is just what we're doing in terms of demand zones. So if even in here, we'd probably be worried about it. So what I would probably do is I would recognize by essence of having a zone that we should be watching is set some kind of alert for it up here. Let's just say we were doing that. Now, would you like to go through, Ty, what we'd be looking for a turnaround event here?
Yeah, most
just
definitely.
Theoretical.
First things first, even on that time frame that we saw there, one thing we do love at all of our talks we do is actually patterns that confirm each other. Now, I think that was on wherever that inverse head and shoulders was. You can see that the actual take profit zone for this was actually basically in the zone that we're aiming for in the first place. So aside from the fact that support and resistance there, we've got the pattern confirmation actually fulfilling it in that rectangle anyway. What we're looking for, and this is where you've got to be mindful, and it comes down to basically, how much time you've got. Are you in front of the charts all the time, or are you only sort of looking at it a couple of hours a day? If it's in that rectangle and you start to see a series of lower highs and lower lows on a smaller time frame, you could be getting that signal that it's going to actually, your profit might be starting to reach its maximum. It may not get as far as it needs to go. So, definitely you're looking for that change of trend. Once it does that, once you've got that little arrow sign, I know you're at that signal there. Once we've got that weakness there, you're absolutely looking at potentially taking your profit out, at the very, very least breaking even and moving your stop loss up to protect what you've already gained, because the market is telling you that it's potentially going to reverse. It's not as strong as it was, and it might have run its course, and you don't want to be giving it back. And even little things like the moving average crossover. I mean, as you can see there, those sorts of things are all little clues that you need to basically pay attention to. Make sure that you are aware that the trend is starting to lose its momentum. Look at volume. There's all sorts of things that you can do to identify a weakening market, but you don't want to panic either, right? You don't want to be looking at one red candle and say, "Oh my goodness!" But if you get a couple of shooting stars in a row, which is the opposite of the tweezers at that resistance, probably time to get out.
Yeah. So there's some good ways. There's some good ways to get out. Now, obviously, depending on the way that you're looking, conceptualizing your trade, let's say it does come down a little bit further, hits a level like this point here, and then it goes long, stop, movement down, and then through. What you're doing here is by waiting and being patient, whether it's a double bottom, whether it's a lightning bolt, which we use a lot, change of trend, whether it's whatever other reason you're in, you've got a couple of choices. By being patient, you've allowed the market to create new structure. That new structure then can become stop loss levels for you. The problem a lot of people have is they buy. They just go bang, buy. Okay, great. Where am I going to place my stop loss? Here's the issue. I can place my stop loss a fixed amount of pips behind, a recipe for absolute disaster. I did it when I first started. My 15.
I think everybody does.
I think everybody does. 15 pips. That wasn't enough. But look, you've realistically got to put it behind previous structure. And unfortunately, that's going to push you down to this level or some type of moving average or a fix or something like that. So by waiting for the structure, what you're doing is you're actually creating a better ability to have tighter stop losses with the potential of better gains. So it's amazingly powerful. I mean, I know it sounds simple and you're saying, oh, you guys talk about this all the time, whatever. It's different. Like, we're talking about risk management here. One of the ways that you manage risk is that you've got to understand that if you're patient, which is boring, don't get me wrong, it's not fun to do this, but if you're patient, you will get better positions. And when you find better positions, you'll have tighter stop losses, which will allow you to make better ratios from your trade.
Yeah, 100%. And look, does it sound repetitive? Does it sound boring? Probably yes. Yeah. And yes, I don't know about you, but I never get bored making money, right? We only talk about things that work. The reason why we keep repeating everything over and over again is because it's exactly how we trade and we know it works. And, it might sound like we're trying to drum it into you, but you'll notice that, you can go back to our webinars for the last 3 or 4 years. We were talking about the same thing 4 years ago. Why? Because it works. And you don't change, because you know what? Price action doesn't lie most of the time. Sometimes it can be a little bit deceptive. Sometimes it can be a bit sneaky, but most of the time it doesn't lie. So when you do understand the candle structure and you understand what price action is trying to tell you, you're generally going to be led down a path, that is generally more than likely going to work out most of the time. And that's all we expect as traders. It's not going to work out every single time, of course not. But for the most part, it will. And that's all we're looking for. We're looking for that edge, and price action gives us that edge.
So we've got another question here coming in from Cortez. It says, gold always does that to me. I get a good signal, and before I know it, my stop loss is triggered, only to find out that I had to wait for the correction candle. Yeah. So look, gold can do that. It can stay in really tight ranges for a while. Now, recently, gold's had an amazing beginning. Now, funnily enough, I wouldn't mind talking about gold on the daily here, because I remember discussing it in February and seeing this exact entry, which was coming back down to a point of support. This goes back to Jaw's question before, where can it be powerful? Around a position of key support or resistance. Look at this. Look what this began. Phenomenal. I'm not stressing enough. It doesn't happen every day. You don't see very often 2 of them, okay? Not next to each other. But when you do see them, they can mean some pretty aggressive moves. Here's an example of where you wouldn't pay attention to them. It didn't really pull back. It's in the direction of the trend. Okay. So that's a great example of when you wouldn't pay attention to them. And it's a very simple thing, but definitely quite relatable. So right now, if you look at gold and you said to Tyrone and I, what do you think about gold? I would say it looks like it's holding at this current zone. However, we don't have a clear signal or direction from it at this point. And you can tell in the price action. You go down to a 4 hour and you start looking at it and you say, well, has it bounced a few times? I guess on the 4 hour, it's bouncing better. And this is certainly a level of support. I mean, you have had a little bit of wick purchasing, but until it breaches past these periods here, e.g. the 1940 plus, and actually starts to break this series of lower highs that are coming through, Ty, it's going to be hard pressed to really love gold right now, isn't it?
Yeah, that's exactly right. And yeah, look, it looks, for all intents and purposes, it's caught between two bands. I mean, it's caught between the 20 moving average and a little mini support zone. And until it breaks out of that zone, you've got to trade, what you see. And what we see at the moment is just a very sideways moving instrument. And I think that's very obvious, isn't it? I thought it was.
Well, it certainly is like fairly range bound. I think what you're looking for a lot of the time, gold can be range bound. So like over here,
it doesn't mean you can't trade it, right?
Back.
Yeah, I think the point to take out of that is that if you understand what you're dealing with, you trade accordingly. So if we're trading a range bound market, use the range bound indicators, use the range bound preparation. Have you take profits at the top of the range? Have your stop losses below the bottom of the range? And, if you can trade within that range successfully and use the right indicators for the job, it's going to be a great way to trade it. There's no question about that. But this is not where you're setting long set and forget positions, right? That's the whole point. Understanding that we are in a sideways market here, even if it's only short term, even if it's only on a small time frame, trade accordingly and aim for the right places. The biggest mistake people make is they actually don't understand which market they're trading. They're trying to place long-term positions in a range-bound market, or they try and place range-bound trades in a trending market. The complete opposite of what you should be doing. Understand the market first. Let price action dictate the way. And if you trade accordingly to that, there's not too many markets that you're not going to be able to trade most of the time. You're going to find a way to trade it. You just understand what it is actually trying to tell you.
All right, so we'll answer a couple other questions. I saw that Darth Vader here had how much percentage do you risk of your account per trade? Generally about 0.5% to 1% is a good rule of thumb for most traders. Obviously, risking less is important. You can still get 3, 4, even 5, even 10 to 1 trades if you have the correct risk management and you're patient enough. I wanted to really discuss one last concept here, Ty. Now, someone just said euro pound. What's that chart doing? I'll just quickly show it on the daily. Yeah, look, the euro pound, I don't think it has a clear direction on what it wants to do. So I think it says here, could you have a look at the euro pound 30-minute chart? Seems to be playing out funny. So yeah, 30-minute chart here. Well, it's at a point of support from previous, and it's jumping all over the place. And even coming into this, I mean, you had a really tight range that breached out. That could have been a position. Obviously, tight coiling ranges can be very, very nice trades around support. You can see the support. But at this point, no clear direction. A little bit of resistance here. It's breached low. It's not in a coiling market. It's just kind of sitting at a level of support would be the way I'd consider it. Let's go over, though. I want to ask people here whether they know some of the majors and whether they know some of the things that go on during times of uncertainty or high volatility. So can everyone in the chat read off to me, let's say, the top 4 currency hedges in the world during times of uncertainty? So obviously we've got the Russia-Ukraine situation. When that first happens, we usually see a flight to safety. Where does that tend to go? What are the couple of currencies that tend to be the strongest during that period of time? Does anyone know? Hopefully you do. Let's see if anyone knows. Another question while we wait for that, Ty. Hourly candles against weekly or bigger time frame, which ones to consider best to trade? Oh, there's no doubt that the weekly is the best because it gives us the clearest signals. However, because that's the big trade. But that being said, they're slow and it's takes a long time to get set up. So you're not going to get as many. So as you go down the time frames, your percentage of being right is going to decline. You'll be more correct on a daily and weekly than you will be on a 5-minute, 15-minute. That's the stats, isn't it, Ty? You're just never as accurate.
Yeah, 100%. Yeah, it's we've always said the bigger the time frame, the more accurate the indication. So realistically, and without being silly, like we're not going to yearly candles, monthly candles, or anything crazy like that. But a daily signal is always going to be stronger than a 4 hour. 4 hour is going to be stronger than an hour. and all the way down to tick charts, which is Thomas's favorite chart. So yeah, the bigger the time frame, the more accurate the signal. It's really as straightforward as that. But we love 1, 4, and daily. That's probably our bread and butter. Weekly for observation, work it down from there. The 4 hour and daily and the 1 hour are our favorite charts.
Absolutely. So we've got some great answers coming in here, Ty. People are very correct. So they've said the CHF, yes, the Swiss franc tends to do quite well. Why? It is a bit of a tax haven, and people tend to move out of the euro and they jump into the CHF. Absolutely, they do. The Japanese yen is also considered during Asian crisis periods to be a potential hedge, you would call it. The US dollar obviously is the major hedge. And then, yes, gold is actually a currency, and therefore, it was the original currency, wasn't it? And we need to remember that. So yeah, these tend to be the places that you would say is the flight to safety. And in the times of high kind of safety, people looking for safety, usually the CHF and the US dollar are very strong. So what you need to remember is every time you've got like one of these global kind of issues, you tend to see money flowing out of Europe, which is what we've seen this time, and flowing into US dollars, flowing into CHF, flowing into some of these other currencies. The same goes for the pound. Now, when it's risk on and all the fear abates, they tend to move up as well. And if you understand one of these basic principles, obviously it's a macro principle. It won't help you necessarily on a 5-minute, 15-minute. It becomes more clear. And I think a lot of people trade currency and they don't understand that there are some hedges, there are majors. And right now, again, the odd is also a bit of a hedge. So, the odd is also a hedge because it is very tied right now to things like minerals, to things like metals, to energy, to things that are doing well. And yeah, that's interesting, because when you then go and say, okay, I'm going to be trading yen pairs, and this wraps right back tied to that idea of the US dollar yen, would you have been better to potentially go with the strongest currency right now, which might have been an odd yen? And the way you can tell that is very simple, because all we would do is we would type in odd US dollar and we'd see, well, how has the Australian dollar been going in comparison to the US dollar? If the odd has been stronger, which it has, so relative performance is very good here on the odd, then we know that the US dollar yen is breaking out. Would potentially the odd yen be the stronger trade? And the answer is generally going to be yes. So really, as an intermediate trader, as someone that's moving into an advanced trader, think about comparisons. If you see one of the majors going and you go, yes, I'm really interested in this trade, remember, it's all about relative performance. You're an FX trader. You have the ability with Pepperstone to switch into these other currencies. So someone mentioned at the start of this day, I take a basket of the yens. What if you were to go and you looked at the odd versus the US dollar, the New Zealand versus the US dollar? Pick the one that's the strongest versus the US dollar as you see US dollar yen break out, then take that versus the yen. Is it going to be stronger? Most likely, and it will probably give you a better return. So it's pretty big there.
Yeah. Paul's flight to safety is cannabis, beer, and women. Thomas, I didn't see that on your list.
I don't think that's necessarily the big one there. So we've got another question. We need to be trading the markets, Paul. So we've got here ASX 200 is another question, and yeah, I mean we can obviously load ASX 200 up. As we mentioned before, the Australian dollar has been very strong. The ASX market is very strong, and at this stage, I mean, it's one of the ones that's held up the best, isn't it, Tyrone? But I think we'll talk about that more potentially in the webinar that we're posting ourselves a little bit later after this. But yeah, odd ASX market certainly strong at this stage.
I have actually, I'm posting the link in the room. So if anyone wants to join that webinar, it starts in about 10 minutes. It's a free webinar, and the link is actually in the chat there. So just you can copy and paste that if you want to join us.
So Jaws says also, I'd say the CAD and NOK, which have got to do with oil. Yeah, well, that's right. If you know the oil correspondence, obviously the ratio, and if no one knows this, if you trade CAD and you don't know that it's very correlated to oil price, Might want to go look that up on Google quickly and see the ratio of relative performance. It is quite strong. So today, Ty, we covered so many great concepts. We obviously covered the tweezer. We covered the idea of waiting for the market to then find some momentum and go through. We covered the idea of obviously looking for when a market pulls back, waiting and being patient for that turnaround story. And we did that on something like the pound over here, where we were just looking at an interesting area. And now we're going to obviously be targeting some form of turnaround from, a prospective kind of, technical concept or anything like that. And then we looked at a whole bunch of relative performance and other things. So hopefully you enjoyed the session. I know I always enjoy doing these types of ones that are a little bit more just in this intermediate thing. It is risky out there right now. That means the volatility is very fierce. I expect all of 2022 to be volatile. Remember, it is a midterm year in the US. The VIX is going to remain high. We're seeing a bit of a rip rally here in indices around the world. That is, they're moving up quite heavily. But if history is anything to go off, Ty, there could be some amazingly big volatility in the middle of this year as well. And I think it's the year of the trader. So get excited, because your Forex pairs will be going wild along with everything else. Central banks are back and they're doing things, which they didn't do for about 2 years.
It is definitely the year of the trader. That's for sure.
All right. Well, thank you so much. And we hope you enjoyed it. Tyrone, do you have anything else that you want to mention to the community? And obviously give us a thumbs up if you enjoyed the content today.
Yep. No, I think we're pretty much covered. If you, like I said, we've got our webinar starting in 10 minutes. So if you'd like to join in on that one, just copy and paste the link that's in the chat room there. You can join us, and we're going to have a deep dive into the live analysis on a few of the different pairs. And yeah, I think, look, just be, like Thomas has said, just be very, very mindful that we are in a very volatile market. It doesn't mean that you don't trade. It just means that you trade probably with a little bit more caution. And certainly make sure that your risk parameters are set correctly, because you can be whipsawed out, and there's nothing worse than that. So just trade carefully, but be productive. It's a good market out there.
I'd like to ask everybody as well, would you be interested in us doing a session a bit on something like Wyckoff or distribution and these types of things that occur? They are a bit of a slower setup, but when you spot them, they can be quite powerful. Does anyone here trade Wyckoff? I mean, I know it's not something we've done here for Pepperstone, but if you're interested in that type of thing, please do request that kind of stuff, because we'd love to always break down markets in a different way so you can see it. What you'll find, though, is no matter what thing you learn, whether it's Elliott wave, where it's price action with supply demand, whether it's Wyckoff theories or Dow theories or whatever, it actually all comes down to one thing, and that is you're interpreting market psychology, and you're interpreting two things: greed and fear. And when you think about it that way, things become a little bit simpler. Thanks so much for joining us today, everybody. Give us a smash to the like, the thumbs up, and of course, subscribe if you haven't already done so. We'll catch you soon, and thank you so much.